You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim, and good to be with you and your listeners.
Well, a couple of things to talk about. The Fed, a non-decision from them yesterday, and the Bank of England is looking at negative interest rates because they claim people are hoarding cash.
Oh, the horror of it. At any rate, yeah, this was a 2-day Federal Open Market Committee nonsense stuff. And the amount of debate going on about will they or raise rates or not is staggering. And the whole issue that we've been making is that it doesn't matter what they do anyways, because at times of great changes in financial markets, such as we're in now, the senior central bank has been behind the changes in market rates of interest. And the other thing I've always felt that, in the 1930s, you had Treasury bill rates at 0. And one of the reasons why Treasury bill rates were at 0 was because the Fed was being monstrously easy. And in early stages of a contraction, people were not expanding capital, plant, and equipment, so the money was going into savings. And then, the safest place to be is the most liquid item, and that was U.S. Treasury bills. So I'm not so certain that the Fed in the 1930s drove the T-bill rate down to 0. I think market forces did, and I think the same thing's going on now. And the irony would be very exquisite is that maybe the Fed can't raise interest rates because everybody's buying the T-bill on stormy days. So, of course, I don't know that one can ever determine that. And then over at the Bank of England, their chief economist in this little article I'm looking at now, who only a few years ago seemed to be reported as a sane guy, now he's gone ultra Keynesian and is looking at calling for radical stuff to support the economy, negative interest rates, and even suggests that individual cash should be abolished. So this is a big admission that their theories are not working. Of course, their theories have never worked. And what could happen here is that market rates of interest, perhaps definitely for lower grade bonds, can continue up, and maybe at some point it may even take long treasuries up. You've had, of course, in Europe, earlier in the year, the most extraordinary decline in interest rates ever seen of items that trade with a date on them, and these were 10-year notes. So they have been turning up from their extremes early in the year, but not breaking out now or anything like that. But it'll be most interesting if those yields do break out. In the meantime, if you go back to the Wednesday, Thursday stuff on the Fed, and nothing. No change. And so there's been a sell-off, but people tie that to the no change. But we were looking at things here, and when you've got crude oil going up, it's been helpful to the stock market. Also, copper going up has been helpful. And on the seasonals, from oversold a while ago on those two items, expected a rally up until the middle of September, and they made it. And as of today, they're down fairly steeply, and stock markets around the world got hit pretty hard, some 2 and 3% declines on indexes. I think I saw the stocks index for Europe down about 3%, so it's pretty heavy-duty stuff here. And it's also within the time when serious credit problems can be discovered going into October. So on the bigger picture, let's look at this. You had the Chinese stock market complete a bubble in June, which was the probable time when it would. And on our technical work, it needed to do another cluster of what we call upside exhaustion reading. We only got one of those, but it was enough. So then it took everything else down with it. But since Black Monday, August 24th, there's been rebounds and stabilities and whatnot. But on the S&P, we needed to have the rebound out of that trashing go up, and on our CCI momentum thing get up to 100 or something like that, which it did yesterday. So the objectives on a rebound out of Black Monday have been met, and now things seem to be weakening, and it's again coordinated with weakening, again, basic commodities heading down. So it looks like we could slip into some even heavier selling pressures into October. And then the other one that has been our faithful guide has been the credit spreads between U.S. triple B corporates and long-dated treasuries. And that one gave us the turn in June, and when that widening of spreads broke out on the chart to new highs, that was a warning, because we were comparing that to 1998, which led to the LTCM disaster, and also to 2007, which ended the party, and then 2008, which really put the crash on. So, but in September, using those two examples, 2007 and 2008, you could have a few weeks of relief in the trend of widening spreads, and so that's what we wrote a couple of weeks ago. Would the relief in the credit markets last for 2 weeks or 4 weeks? But this is the second week, and it's passed, and as of today, spreads are back to widening again. So it's a coordinated event with stocks heading down, key commodities heading down, and credit spreads widening. Not a pretty picture.
We'll have more with Bob Hoye right after this.
Unbelievable harmonies, spectacular performance, Bird Dog and the Vintage Electric Band, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. In Oliver, October 2nd. In Kelowna, October 3rd. Buy online and save at ontourtickets.com. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. China's approach to the downturn in their market, well, we're not going to make short selling illegal, but if you do something we don't like, we'll throw you in jail. And they said they're going to hunt down the culprits who have caused the market to go down. Who are they going to find, Bob?
Yeah, well, this shows that policymakers are so naive. Now, I believe that many in the Beijing government have become oligarchs with huge amounts of money. And the instruction for history here is that you had essentially a communist government riding a financial bubble, and it got exhausted on the upside and got hit very hard. And their naive move was they halted trading on a number of leading stocks, they halted the short selling, and they put a huge amount of money into buying, and it didn't work. And this is the major instruction, is that a massive effort was made to prevent the setback to the stocks, but it would depend on which index you look at. I guess it was 35% or 40% at its worst, and then it became oversold. And as I said, we needed to get a certain momentum on some of these important stock indexes to complete the rebound, which we've got on the S&P. So then I saw a note where they had thrown 200 people in jail, and one journalist who was with a responsible publication, and he at some point a number of months ago said that perhaps this is all beginning to be too much. So even those who made a call or identified the speculation as excessive have now become enemies of the state. And this is really scary stuff. And how far will it go? But it reminds of the 1930s in Russia, Soviet Russia, where they had made these perfect 5-year growth plans, and done by central planners with complete authority. Of course, it didn't work out, but they couldn't figure out why it wouldn't work out. So then they had to have a reason for why it didn't work out. So they had these show trials where various ministers or department heads were put on trial, and they confessed that they were Western saboteurs and they sabotaged the economy. They went to their deaths. So I hope it's not that severe in China, but who knows on that matter. So again, to repeat, the instruction is that the state made a massive effort to prevent a decline in the stock market, and it's not working, and we're now on the next phase of illiquidity. So there'll be even more accusations, I guess, coming out of Peking, but the main thing is that they are doing financial history a wonderful service by making a huge and well-publicized effort to prevent a contraction. And as we like to say, that once the bubble is over, the power shifts from the central bankers to expand credit. It shifts over to the margin clerks who are there, and their job description is vastly different than the central bankers. Let's use the Federal Reserve or the Bank of Canada, for example. Their latest efforts have been very radical, and you can say that their efforts were to try to get the stock market up, which means you want to have the speculators with you getting highly leveraged. And so their job has been to get the accounts out of line. And then once the momentum goes out of the market, then prices go down, and then it shifts over, the power shifts over to the margin clerks. And their job description is to get the accounts in line. And in every contraction, they have overwhelmed the central banks. And let's just look at the start of the Federal Reserve in 1914, and there's been 19 business contractions since then, and as many or maybe more bear markets. But their theory isn't working. And so then this gets us back around to recent statements by the guy at the Bank of England that they think that they've got to take it to another step, that to eliminate cash transactions so people won't hoard cash, so that then their theories will work. I mean, these guys are stark raving mad. They should, well, not in a loony bin, but you can't have a whole bunch of economists and central planners and central bankers being out of work. So let's just keep offices for them and have their computers hooked up like it was some huge game they were playing, and have absolutely no external outlet from it. So it's a constrained system, and just pay them to go and practice their Keynesian games, not hooked up to the economy and everything else. And it would save us a whole lot of speculative furies out there, but of course that's not going to happen, but maybe we can bring this up for another day.
With the markets not doing so well, how come gold prices haven't shot up? Usually we see that happen, or is that going to happen? It's just delayed.
You're a day behind on that one. These hits to the New York stock market have been accompanied by a weaker dollar, perhaps, as maybe those riding the popular stocks take their money back home. I don't know. It's very complicated. So the dollar is down, and with this gold rallied, it got into an oversold condition, and yesterday we came out with a target, I think 1145 to 1185 as possible. The gold stocks, of course, rallied with this, but it's not out of a really secure, sound base for the gold stocks. It's very interesting, but I think there's still some risk if the S&P goes down further. I don't think that the gold shares can rally too far, but we'll watch. I think we need more stability in the gold sector before one would invest in the gold stocks. Sure, some traders will make some money out of the swings in here, but we would need more stability before one would really begin to get back into the sector. The other thing that's interesting is that the weakness of the Canadian dollar with generally weak commodity prices, but also part of it could have been due to the public opinion polls on the forthcoming general election in October, which had at one moment the governing party in third place, the Conservatives, and the Socialist Party, the NDP, in first place in the polls. And of course that would be a depressant to any currency. But what we've had here is the Canadian dollar's come down into one of our buy patterns, oversold and doing the sequential buy pattern, and perhaps it may be rallying with gold because you've got copper and crude oil down hard today, and maybe it's rallying because the prospect for the Conservative Party getting back in is improving. Maybe they could end up with a minority, which would be, in the face of having a bunch of socialists in, it would be a very strong plot for most everything. So we'll watch that trend and enjoy the gold rally up to a pretty good price, but for the whole gold sector, we'd want to have a few weeks of stability before we can really get serious about it.
Bob, thanks a lot for chatting with us.
Yeah, Jim, always good. Always enjoy our Fridays together.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. His website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter or Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.